let's see how much about mutual funds, closed-end funds, and ETFs I can get through. So here are some practice problems I think are important and useful. Here are some key terms that I wanted to call out. So this should be posted to Canvas so you can see them there. Here's what we'll talk about. So let's go ahead and just dive right into mutual funds. What are mutual funds? Oh, I thought I turned off the animations. Sorry about that. There's going to be lots of animations now because I didn't turn them off. So what are mutual funds are typically set up to have specific investment objectives. A U.S. Treasury mutual fund, not just the U.S. Treasury mutual fund, but targeting a 6-year weighted average duration with a range of 5.5 to 7. Or corporate bond fund, mutual fund that focuses on investment grade of 5 to 10 years in maturity. They can be allocated 30% bonds, 10% alternatives, and 60% equities. They can be geographically organized in terms of their investment objectives. They can be actively managed, so the portfolio managers, the mutual fund managers, actually actively choose, okay, which companies do we think are going to outperform, or they can be indexed. And that's the approach of Vanguard. Don't look for the needle in the haystack, just buy the haystack. What's the difference? Actively managed are more expensive. They can have front-end load fees, back-end load fees, which back-end load fees are often reduced. And didn't put the phrase that the textbook uses. Let me see if I can find it quickly. But essentially, giving you a break if you keep your money locked up with them for a certain period of time. Let me see if I can find it in here quickly. Because it really does describe it well. A redemption or exit fee. And the ones where the fee actually is reduced over time, they're known more formally as contingent deferred sales loads. Contingent deferred sales loads. I'm not saying that because I think it's testable. I'm saying that because it might make more sense. Contingent deferred sales loads. So if you wait longer, your redemption fee goes down. 12B1, that's named after the rule. It's actually kind of like the chapter and section for mutual funds, the fees that they can charge to cover distribution costs, advertising, promotional literature, annual reports and prospectuses. There's also an expense ratio, paying for the computers, paying for access to research, the building, the telephones. Mutual funds typically have a pass-through tax treatment. So taxes are borne completely by the investor. And there will be distributions from the mutual fund. Some will be income, which will be taxed as income. Some will be capital gains, again, taxed as capital gains. So let's work through a fee example. And again, I'm sorry about the animations. I must have been using a template that I wasn't looking at carefully. Mutual fund max load investments has a 5% front-end load, a 6% back-end load that reduces by 1 percentage point per year, a 25 basis point 12B1 charge, and a 75 basis point expense ratio. Let's assume a constant 5.5% return on net asset values per year over the next 6 years. What are the annualized returns for an investor, a retail investor that puts up $10,000 and holds it for 1 year, 2 years, 3 years, 4 years, 5 years, and 6 years? What does their return look like? So those of you that are, unclear as to what these mean, front end load, I have to pay 5% upfront. As soon as I buy it, $10,000, they take out 5% straight away. So $500 out the door. They charge 25 basis points a year for the 12B1 charge and 75 basis points a year just to cover their expenses. Pretty expensive fund. Here's what it looks like. So here's that front end load, 5%. As soon as you buy it, your value of your investment is now $9,500. If you decide to redeem that at any point during the year, whatever the market value is, you have to pay 6% of a redemption fee. Probably don't want to redeem it. Then, end of every year, I know usually these expenses, the 12B1 and the expense ratio, I think typically accrue daily. But let's just say they're incurred at the end of every year. So you take out a full percentage point combined between the 12B1 and the expense ratio. And even though NAVs increased by 5.5%, this is only a 4.5% return on the value because of those expenses that are being incurred. If you redeem it after 1 year, you have to pay a 5% back-end load fee. You get $9,426 back. You've lost 5.7%. Doesn't seem like a good deal. All right, let's look at year 2. You still have to pay the 25 basis points, 75 basis points, a full percentage point. The NAVs earn 5.5, but you have that 1% hurdle, so you actually only earn 4.5%. You do have a lower back-end load fee of 4%, but you still lose money. That's the annualized return. So 0.26% loss per year compounded. Year 3, these all just, the NAV here just is increasing by 5.5% every year minus the expenses, back-end load fee. Your annualized return over those 3 years is 1.64. You kind of get the picture. So while the fund performance is earning 5.5%, which is a respectable return on a mutual fund, this investor is not making out very well. Why does the back-end fee exist, and why do they reduce it every year? These different fees, usually I don't think many mutual funds have both back-end and front-end load fees. And in fact, most of them, because of the competition in the fund space, has become much tighter. Those have been reduced significantly. But they're essentially just different ways to earn revenue. There are some essentially sales commissions for brokers that those fees essentially mostly go to pay those brokers. So think about financial advisors who work at different firms. They may really like one specific mutual fund and sell it to their clients. In the prospectus, if the client bothers to read it, the financial advisors are getting paid to sell those mutual funds, which typically comes out of the load fees, whether they're front end or back end. Not all mutual funds have these kinds of load fees. John Bogle created Vanguard because he saw this and said, this is ridiculous. If we just create a really low-cost mutual fund that everyone has access to, don't charge front-end fees, don't charge back-end load fees, and just create an index fund. Just track the S&P 500, just track the Russell 2000, the Russell 3000, value, growth, whichever one you want. Reducing those costs is much better than trying to find a good active manager. The research he did at a very young age, I think he was still in college, showed that being the best fund manager was simply more of playing roulette. It's very difficult to find one specific fund manager who consistently outperforms everyone else. So he saw that as, why bother? Focus on reducing costs. And he created Vanguard. Sadly passed away, I think, 2 years ago. He lived a very long and full life, so should be celebrated. And his life brought us access to low-cost funds, which I think is pretty valiant legacy. The infamous Warren Buffett challenge. That's a great one. Warren Buffett challenged a hedge fund manager. I think he was a fund of funds manager. That's in the textbook, although I don't expect you to know that part. A hedge fund manager who essentially just invests in hedge funds. And said, this was in 2008, right before the market really tanked. Said, I'll bet you $1 million that if I just put my money in, we track the value of the S&P 500 ETF, you put $1 million, funny money in whatever hedge funds you want. Pick, I can't remember. I think he said a number, it's like 5 or 10 hedge funds. And he said, I'll bet that my investment in the S&P 500 will outperform yours. And he won. And the hedge fund manager had to donate $1 million to a cause that Warren Buffett got to choose. I mean, that was the deal. It was a deal for charity. It was also very illustrative how difficult it is to actually beat the market on a consistent basis. So, don't get fancy. It's a good motto. All right, closed-end funds are not really that popular anymore, but they were a fascinating topic. They did essentially kind of pave the way to what eventually the innovation of exchange-traded funds. So mutual funds are essentially new investors can invest new money into a mutual fund at any point. It settles after the close of trading, so that the mutual fund can actually say, okay, well, here's how many quote unquote shares you own of the fund, and they manage the fund and the cash flows as best they can. Closed-end funds would issue shares and use those share proceeds to buy assets, usually securities. But there were a fixed number of shares outstanding, and if you wanted to redeem your shares, you don't redeem them, you sell them to someone else who wants to buy them. And something that happened over the course of time is that these closed-end funds typically traded at a discount, usually a pretty significant discount to their net asset value. And Lee, Schleifer, and Thaler is a Nobel Prize-winning economist, they studied this and they noticed that if they segmented the 26 years that they were looking at, there were 14 years in which no closed-end fund was started. So no creation of a new closed-end fund. There were 12 years in which at least one closed-end funds had been created. In the years when no new closed-end fund was started, the average discount price to net asset value was 13.6%. Sometimes it got up to 15% on average. On an individual fund basis, sometimes it got significantly higher than even that. And so this was really confusing because it made no sense. It made no sense. And so some pretty sharp people decided, well, maybe we can create something that tracks an index but doesn't have that problem of a significant premium or discount to the net asset value. That's the birth of exchange-traded funds. It wasn't called that originally, but it is now. So really quick show of hands, has anyone heard of authorized participant before? You can use the chat, or I think there's a raise hand feature within Zoom. No one's heard of this before. It's completely new. Okay. So authorized participants are typically large broker-dealers that essentially go into the marketplace. And let's use the SPY, the oldest and most heavily traded S&P 500 ETF in the market. Although I think that they're getting a lot of stiff competition from a few others, at least these days. An authorized participant might notice that the SPY is trading at a 1% discount to its net asset value. So what's the old adage of investing? Buy low, sell high. So the shares of the ETF are trading at a 1% discount. An authorized participant can go and buy a whole bunch of shares of the ETF, short sell the underlying securities, deliver the shares to the ETF fund manager, redeem those shares for the underlying security, the underlying shares, and close out their short position. They've made 1% minus a small creation redemption fee without taking any risk. Does anyone find that to be problematic? Does anyone find that to be a little bit immoral or unethical? It's okay if you do. I want this to be a safe place for discussion. This is an opinion.
I'm just curious what purpose it serves, because if it serves a legitimate purpose, then it might not necessarily be unethical, but just to have a free 1% wealth creation, that seems strange.
Right. It keeps the price of the ETF close to the net asset value. Because if an authorized participant sees that, that means that other authorized participants see that, and it means that they're all going to start chasing after that 1%. And if they do, they're going to bid up the price of the ETF, and they're short selling the underlying security, so they're forcing those prices lower at the same time. And so it keeps the price of the, it's more likely the ETF that's going to be impacted, by the way, but it keeps those prices closer to each other, and it rights that imbalance. when that's going on, that means that there's too much selling pressure on the ETF for the ETF to actually manage the shares outstanding. The authorized participant will step in and essentially right the market imbalance. Now, usually it's not a full percentage point. Usually it's 3 basis points, 3 or 4 basis points. Because the authorized participant has to pay the ETF manager a fee to cover the costs of creating or redeeming shares. So the benefit is it keeps the prices close to the actual value. And yes, it is a balancing act. They are balancing the prices. They're balancing the order flow. I was going to do all this, but I just simply don't have time. I have some, visual participation. So these slides just go through exactly what I told you. What I explained to you is the redemption process, where the ETF shares are trading low relative to the net asset value. What happens if the ETF shares are trading high, which means that more retail investors or general investors are buying the ETF as opposed to buying the underlying securities, and so the price goes up above the net asset value. The underlying securities are trading at let's say, a 0.5 percentage point difference. Buy low, sell high. The authorized participant short sells the ETF shares, goes out and buys all the underlying securities, delivers those to the ETF fund manager, pays the creation redemption fee, gets the ETF shares, and then deposits those to cover their short sale of the ETF shares. The ETF fund manager is happy because the price is close to the net asset value. And also it's managed the imbalance of order flow. If there aren't enough sellers of the ETF for the buyers, they have to create new shares somehow. But there's that creation redemption fee. So there's a little bit of a narrow window of premium and discount that ETFs can operate in. And it depends on the ETF. A narrow window where the premium and discount will not create a big significant flurry of creations and redemptions, which is to the benefit of the ETF fund manager also, because they don't want to have to create and redeem shares all the time, only when they need to. And each ETF will have this listed. Some it's more clear than others. Some ETF managers make it easier and more transparent to get their data. Others, I think it's more a matter of just they don't want to bother with that extra cost of making it easier to get to. You still can get to it. It just takes a little more digging. But for the SPY, which is because it's so old, they've created new legal structures that actually make the ETF management process more cost effective, more cost efficient. So it's $3,000 per 50,000 shares of the ETF. Last I checked, I think that was about 2 basis points of value. It might even be less than that. It might be less than a basis point. But VOO, which is Vanguard's, it's essentially, well, it's not quite 1/3 because the share price is a little bit different, but it's significantly less. They created VOO, I think 6 or 7 years ago, whereas the SPY was created, I want to say late 1980s. The first spider. This goes through the redemption process I talked about earlier. Any questions about the creation redemption process? It's important to understand that the purpose of the creation redemption process is to help with the management of shares outstanding in a much more cost-effective way and efficient manner, and also to keep the prices of the ETFs close to the net asset values. The ETF, the way that they created the first exchange-traded fund, they said, we need to create something that doesn't have that problem that closed-end funds have. How do we solve that problem? Oh, we can have authorized participants that actually create and redeem shares with us, and they're incentivized to do it as well to keep the price honest, close to net asset value, because they can earn a profit when there is a premium or a discount. So the incentives are aligned. People still have the opportunity to make money, but the incentives align to the same end goal. So some types of ETFs that you may have heard of: passive, index tracking; active, focusing on value, growth, active management of bonds; industry focused, healthcare, consumer discretionary, consumer staples, industrials, transportations; geography, commodity, volatility, leverage. You do have to be careful. Some of these are not funds. If you look at the details, they're actually exchange traded notes that can be redeemed if certain market conditions force it to. A very famous one is called XIV, which is VIX spelled backwards. Has anyone heard of VIX that would like to give a shot at explaining it? I'm going over, I'm sorry. Does anyone want to give a shot at explaining VIX, and then we'll close for the day? Has anyone heard of VIX? Just out of curiosity, I won't make you explain it. What is VIX? Okay. Options contracts are, I don't think I talked about options in here, and I don't think we will. Yes, the volatility index, the fear index. So options contracts are contracts where there's a strike price. And let's use a call option contract. I will pay $500 to the market to buy this contract that says I can buy Tesla shares at $750 anytime between now and April 18th. That's an option contract. If Tesla shares go up to $800, I can use my option contract to buy at the strike price, which I think I said was $750. The way that these option contracts are priced, embedded in that option contract premium or price, is something called implied volatility. The VIX is simply the implied volatility from the options contracts market of the S&P 500. And it became such a popular index that the futures market exchanges created futures products that are cash settlement to the realization of the VIX on certain dates of certain months. So now you can have people that use futures to hedge VIX. VIX, the level of the volatility index, typically goes up when stock prices are falling. But for long periods of time, it tends to go down. And even if it's flat, the way that VIX futures work, if VIX even just stays flat, you can earn money by going short VIX futures in the futures markets. They have a cost of carry if you're long the futures, which means you have a yield, a benefit of going short. The only problem is if VIX spikes, then you'll lose a lot of money. As we've talked about going short. Let's see if I can find graph of XIV. Nope. Let's do it this way. I think that's it there. Yeah. Let me go back. View image. That's it. So in early 2018, XIV, which is VIX spelled backwards because it's short VIX futures, VIX spiked and XIV fell by about 90% overnight. And because it's an exchange traded note, due to the terms of the note, it immediately redeemed all the shares and paid back whatever remaining value to the shareholders of record. So overnight, people didn't even have an opportunity to sell their shares back because they were being redeemed. And whatever cash was left over was given up pro rata basis per share. So I've gone over by 7 minutes. I'm sorry for doing that. Sorry for keeping you late. If you have questions, you're more than welcome to email me. If you have a question you have a burning desire to ask me right now, I can entertain those for a few more minutes. But otherwise, have a good evening. Good luck studying. I will post a quiz hopefully tomorrow. If not, then Saturday. I'll also try and post some videos if I can get around to it. If not, we'll just try and continue as best we can. All right. Thank you, everybody. Have a good night.